All right, Juan, good morning and happy Father's Day.
Well, thank you very much. In confinement,
In confinement, yes.
I guess we're both thoroughly enjoying our kids on Father's Day at home. So
I don't know what's worse, contracting infection or being screamed at all day, but we'll
yeah,
see.
I know. I mean, I love them to bits, but it's just not easy. So I apologize if there's any background noise. It is
Yeah,
what it
guys,
is.
seriously,
Uh,
there'll be the occasional cameo on both our sides from
yeah,
a little one intrigued by what we're up to, so please excuse that. Let's
yeah,
go. What are we talking about today? Swaps.
yeah. Today we're talking about swaps. Yes, that's the topic. It's a topic that's very little understood, and it's one where there are resources. So I'll be drawing heavily on an Investopedia article on this one, which I think is a pretty good way to start. So swaps are the Tom next funding rate that uh, spot FX brokers that offer leverage trading on a cash settled basis charge when you hold a position overnight. I guess that's the way to describe them.
Okay.
And the reason we charge that is because in our case we are charged for it because of course as you're de facto holding a position, um, you you're liable for interest rates only if you carry that overnight. But if you do carry it overnight, then there are interest rates that apply from one day to the next. You are borrowing, and to the extent that you're using credit. And today I wanted to explain how that works.
Perfect.
So typically the swap rates depend on the currencies or the out of the pair that you've chosen to trade. There's a long currency and a short currency. The fact of what you're doing is you're borrowing the short currency, you're taking on a liability on that short currency, and
Sorry,
then
who
you
is
are
taking on the liability?
so the fact of basically as you trade, you're taking on you're entering a bet, say that the euro dollar is going to go up, as in the euro will appreciate against the dollar.
Okay.
Okay, that's basically your basic bet.
Mhm.
Now, how do you translate that bet into money? Well, you borrow dollars, you exchange those dollars at the going rate to buy euros.
Mhm.
And then if the euro appreciates against the dollar, then you can unwind your long euro position. With that, you'll be able to buy back some dollars. You pay back the dollars that you borrowed, and then there's hopefully some money left. And depending on which account currency it is, they would be converted into, say, your yen-based currency or whatever. But that's for another day.
Mhm.
But the fact is, there is a long and there is a short currency. And importantly, those carry interest rates, just as if you borrow from the bank and they give you, they give you a loan for 5 years, then you have to pay a yearly interest of X for that money.
Yep.
And if you invest in a bank, then, then you actually get some interest back from that. Typically, you borrow for, your borrowing is more expensive than you're investing because that's how the middleman makes money. But that's about the long and the short of it. Okay.
So from a trader's perspective, essentially, if they roll their positions overnight, they stand to either make or pay swaps depending on their.
Well, they might actually, I mean, depending on how the spreads are, they might actually stand to pay one way or the other.
Yeah.
It's a question of,
Yeah.
but yes, that's the idea. There's one currency, the borrowed currency, for which they'll stand to pay interest, and then there's a long currency for which they'll stand to kind of make the interest. And depending on the differential of those two, then you could make money, or you could get paid a carry, or you could carry the carry. I guess
Right.
that's the way to look at it. Yes.
So it's good at
Um,
this point to sort of clarify then that Darwinex, when swaps are charged, the rationale behind that is that Darwinex is being charged those swaps too, right? On the
Yeah, I mean, I guess this goes back to there's a fundamental issue with the way CFDs are priced in that the leverage is not necessarily embedded in the price that you pay. So
Mhm.
the spread, if some brokers or some dealers who make just the spread and they make a commission,
Right.
they really make the same amount of money whether or not the customer is leveraged 1x or 100x,
Right.
and those two customers pay the same volume driven rate via the spread or the commission as they trade, but one thing that's not accounted for is the balance sheet risk that is embedded in offering the leverage.
Okay.
And by that I mean de facto, and especially since ESMA introduced the negative balance protection, uh, you basically have a free option in that you take a position with as much leverage as you can get, and if it goes against you, then all you can stand to lose is your margin, but you're de facto drawing on shareholder capital by the brokers to leverage your bet. So it's a free option in that sense.
Okay.
Um, so that's an implicit thing there, which I've really I think there's a mathematical way to do it, and I think the founder of Oanda once I think that Oanda was built on that premise. That's something I would have to look into, but I guess that the swap rates are exactly for that reason. Okay, now why do we charge swap rates on our customers? Well, we charge them because if we have an agency trade and Ali is leveraging Darwinex as his broker to take on a position, then we hedge that position out with the market, and the market is going to charge us a swap rate as well. So if we didn't charge that swap rate, we would actually operating at a loss.
Okay.
That is the reason, yes.
Got it. And I think one more element of this from a trader's perspective is the differential in swaps depending on certain days. There are certain days of the week where clients will get charged a multiple of the normal swap factor. What is the logic or rationale behind that?
Yeah, the logic for that is basically the settlement rate date. So typically the trades are settled on a T plus two basis, but in some situations when there are whether there's a weekend or there's a holiday, I mean, I think there's in the Christmas season there are even longer settlement dates. So basically the swaps are charged up until that date because the position will be rolled over until that kind of next business day, and depending on how many days you borrow, then you have to basically pay interest for more than one day.
Ah, I see.
That's the reason.
Okay. Is there anything else in particular with swaps that you'd like to contribute that you feel perhaps traders must or really should know? This anything that you feel is should be in the public domain about such transaction costs from someone being in the
Mm,
industry, someone with your operational background. Is there something you feel traders should know and
yeah, I
they
mean,
don't
I
know?
think there's that basically. I think swaps is an area where it's more difficult, it's more opaque to understand how they stand up, and it just as it's easier to there's a public price for the spread and there's a public commission and so on, and this is the swap rates is a place where some people hide markups to
Mm,
try and make money without people realizing. So that's one area. Another area which we're going to talk about shortly is that whether or not we as a broker are charged swap rate is a function of what percentage of the stock of client flow we hedge out with the market in this case. So if we were to internalize all the flow, which we don't, then we would not need to finance the position in it with the street,
yeah,
and then of course we would have to command some swap because the factor that some the customers are drawing on our balance sheet,
right,
but it could all be kind of free revenue in that sense.
right,
Whereas the more of an agency model you've got, if all client positions are funded out in the street, then it's basically a pass-through charge that we are passing, and that's, I guess, it's a good way to know. So if you find a so-called broker that has ultra low swap rates, then that's probably one of the easiest ways to figure out that they are market making
yeah,
in that sense. And if they are market making, which is fine, but you better don't. If they do, I mean, I guess we've seen this week -20, -30% kind of changes in oil and crude prices, right? And West Texas Intermediate dropped by 20% at within a day, really.
yeah,
And that's when that's the kind of situations which make internalizers go belly up. And whatever monies you've saved in swaps for some time, you might actually pay up with the entire capital when your broker goes bust. So yeah, I guess it's one way to look for hidden charges, and it's another way to for your broker to tell you whether or not they're acting on an agency or a principal capacity.
Great, that's excellent. Thank you. Okay, so
Thank you. And say hi to the kids.
yeah, we'll do. I'm pretty sure they're being heard globally right now. So
Yeah.
thanks, kids. Catch you in the next
Cheers.
one, man.
Cheers, Ali. Take care. Bye.